Good morning, everybody, and welcome to today's event, financial information about your superannuation. My name is Samuel, and I work for the Financial Information Service here at Services Australia. Super can sometimes feel like money that belongs to our future selves. We know it's there, we see it mentioned on our pay slips, but we might not always give it much attention until retirement starts getting closer. So today, we're going to try and bring that future money into focus. We'll look at things like how super works, the different ways it can grow, some of the tax rules and contribution limits, and some of the other things worth checking along the way. Now, before we begin, I would like to acknowledge the traditional custodians of the lands that we're all joining from today. I pay my respects to elders past and present of all Aboriginal and Torres Strait Islander nations. I'm talking to you from Gumbaynggirr country in New South Wales. And if you know the country that you're joining from today, you are very welcome to acknowledge that quietly where you are as well. Now, to help answer questions today, we have staff from the Financial Information Service supporting the webinar. If you're here with us watching it live, you can use the Q&A feature in the top right-hand corner to send questions as we go. We do have the webinar set up to protect your privacy, but we will ask you to avoid using your full name and avoid including any personal details in your questions. Our moderators may respond directly or may publish a question if the answer may be useful to the other people attending as well. If you are watching the recording later, the useful links from today's session will be available in the webinar summary. We may also pop up some interactive polls throughout the webinar. If you feel like you would like to anonymously contribute to them, please do so. If not, feel free just to close them as they appear. Services Australia provides the Financial Information Service, commonly known as FIS. We're a free, independent and confidential information service available to all Australians. We help people understand financial concepts, including superannuation, investments, retirement planning, taxation, and how financial decisions may interact with Social Security payments. An important distinction here is that we provide financial information only, not financial advice. We can explain rules, options, potential benefits, possible consequences, but we will not tell you which fund, investment, strategy, or option to choose. Our aim here is to help you ask the right questions and make a more informed decision by yourself. Now, we have plenty to cover today. We'll begin with how super works and the different ways money can be contributed to your super. We will have a look at salary sacrificing, downsizer contributions, and the first home super saver scheme. We'll also talk about taxation, choosing and managing a super fund, insurance through super, and when your super may be accessed. And then we'll finish off with some online tools and information services that can help you manage your super and keep better track of it. So before we continue, a quick but important disclaimer. The information in today's webinar is general information only. Everybody's financial circumstances, goals, and preferences are different, so you need to consider how this information may apply to you. The presentation is accurate as of today's date. That's the 20th of August, 2026. Superannuation rules, contribution limits, and tax thresholds can change, so please check current information in the future before making a decision. The presentation is also protected by Commonwealth copyright and is not intended to be reproduced or photographed. All right, let's start with the million-dollar question. What is superannuation? Super is money put aside throughout your working life to provide income later on, generally in your retirement. Australia's system is partly compulsory because employers are required to contribute for eligible workers, but people can also make additional contributions themselves. Our government encourages retirement saving through tax concessions and some Social Security concessions. For example, the money in accumulation phase is generally not assessed by Services Australia while its owner is under age pension age. The trade-off for that is that your super is preserved. In other words, it normally can't be accessed whenever we feel like it. A legal condition of release must be met first. There are several types of super fund, although most people will only deal with one or two of them. Retail funds are generally run by financial institutions or investment companies. Industry funds were traditionally connected to particular industries, although may be more broadly open these days. Public sector funds were established for government employees and may include older defined benefit arrangements. A self-managed super fund is privately managed and can have up to 6 members. The members are generally also responsible for running the fund and complying with rules, so this involves significant legal and administrative responsibility. There are also retirement savings accounts and some employer-sponsored funds. The fund type does matter, but so too do its fees, investments, insurances, and services. There are some figures on the screen now that give us a sense of the size of Australia's superannuation system. There are hundreds of large super funds holding trillions of dollars. There are also more than 670,000 self-managed super funds, although each of those can only have a small number of members. Now, that explains why self-managed funds make up most of the fund count, while the majority of superannuation money sits in larger retail, industry, and public sector funds. Altogether, the figures shown here add up to around $4.4 trillion in superannuation holdings. So, safe to say, it's a very large system, and it covers the retirement savings of millions of Australians. Now, because super receives tax concessions and is designed to support people in retirement, it is highly regulated. A super fund is a special type of trust. Its trustee holds and manages assets for the benefit of its members, and the fund's trust deed sets out how that fund will operate. There are several regulatory bodies that oversee different parts of this system. APRA oversees the financial soundness of most regulated funds. ASIC has responsibilities relating to consumer protection, financial services, and the information provided to members. The Australian Taxation Office, or ATO, has responsibilities for areas including self-managed super funds and taxation. The important thing to take away here is that super has strict rules governing its contributions, investments, administration, and access. Now, because of that, super rules can change reasonably often. Budgets, legislation, and annual indexation can all affect how this system works. 3 good places to keep up to date are the MoneySmart website, the Australian Taxation Office website, and of course, speaking to your own super fund. MoneySmart is useful for clear, general explanation and comparison tools. The ATO provides a detailed tax and super rules, and your fund can explain its own products, fees, investments, insurance, and administrative requirements. Be careful when relying on social media or an older article. It might explain a rule that was correct at the time, but maybe it's changed since then. One very useful way to keep track of your super is through MyGov. By linking the Australian Taxation Office to your MyGov account, you can generally see your super accounts in the one place, including accounts you may have lost track of, and any super being held by the ATO itself. You may also be able to transfer money from multiple accounts into a preferred super account. Combining accounts can reduce duplicated fees and paperwork, but don't rush into it. Before closing or transferring an account, check whether you would lose any insurance, investment features, or any other benefits that are important to you. A little investigation first can prevent unpleasant surprises later. There is an estimated $22 billion in lost and unclaimed super held by super funds or the ATO. That's a very large amount of money waiting to be reunited with its owners. Now, people can lose track of super for many reasons: changing jobs, moving house, or changing their name. Others may have small accounts created many years ago that they've just simply forgotten about. So it's worth asking, could some of that money be yours? If I had some of $22 billion lying around, I'd definitely want to know about it. Checking through MyGov takes relatively little time, and it can reveal an old account in some cases. Even if the balance is small, finding it gives you the opportunity to decide what to do with it. Let's spend some time now looking at who can contribute to super. People under 75 generally can make or receive personal and salary sacrifice contributions without needing to satisfy a work test. A work test may still be relevant if somebody wants to claim a tax deduction for a personal super contribution. Eligible people under 75 may also be able to use the bring forward arrangement. Now, this allows them to bring forward future non-concessional contribution limits. For those who are aged 75 and over, the contribution options do become more limited, although mandated employer contributions and eligible downsides of contributions can still be accepted. And we'll take a look at both of those a little further on. Now, these rules can be detailed, particularly around someone's age and their total super balance. So whenever looking at contributions, check your eligibility before transferring any large amounts. Super contributions are divided into two broader categories: concessional and non-concessional. Now, concessional contributions generally go into super before tax. So this includes your compulsory employer contributions, salary sacrifice, and personal contributions for which a tax deduction is claimed. The concessional contribution cap shown here is currently $32,000, $500 per financial year. Non-concessional contributions usually come from money that has already been taxed. So that might be your savings or your net wages. The annual cap is $130,000, although eligible people may be able to contribute up to $390,000 using the bring forward arrangement we just spoke about. Again, these caps need to be monitored carefully because exceeding them can result in additional tax or some other consequences. Now, concessional contributions do include the compulsory super guarantee that is paid by employers, contributions required by an award or industrial agreement, salary sacrifice, and some personal contributions. There are some additional conditions for workers under 18 and people doing private domestic work, including a work hours requirement. Some people may also be able to carry forward unused concessional cap amounts from earlier years. This is generally available where the person's total super balance was below $500,000 at the relevant time, and any unused amounts remain available for up to 5 years. Your ATO-linked MyGov account can help you check available unused cap amounts. The super guarantee has grown considerably since it was introduced, which we can see on the screen now. It began at 3% in 1992 and has gradually increased over time. It was 9% for many years and then moved through several staged increases. From the 1st of July 2025, it is 12%. Now, that percentage is generally based on ordinary time earnings and is paid into super in addition to an employee's take-home pay, although employment packages can sometimes be structured differently. It is worth checking your pay slips and super account periodically to make sure that the contributions are arriving. A contribution showing on a pay slip doesn't necessarily mean that it has reached the fund. Non-concessional contributions are made from money that has already been taxed. So again, this could include personal savings, an inheritance, a windfall, proceeds from selling an asset, or money from your net pay. Because the money has already been taxed, the contribution itself is generally not taxed again when it enters the fund. It becomes part of the tax-free component of the member's super balance. The usual annual limit shown here is $130,000, or again, up to $390,000 using bring forward arrangements. Your total super balance can affect whether you're able to make these contributions though. So again, eligibility should be checked before acting. There are other ways to contribute as well, such as the super co-contribution. Now, this is designed to help eligible low and middle income earners add to their retirement savings. If you make an eligible personal contribution from after-tax money, the government may contribute up to 50 cents for every dollar that you contribute, up to a maximum co-contribution of $500. For the 2026 to 27 financial year, the lower income threshold shown is $49,293. The higher threshold is $64,293. The maximum benefit reduces as income rises between those amounts. There are other conditions that need to be met, including age, employment, business income, contribution limits, and lodging a tax return. The ATO works out eligibility using tax return information and then will pay the co-contribution directly into your super. There are several other ways that super can be used or increased. Salary sacrifice lets an employee arrange for part of their pre-tax pay to be contributed directly into super. A downsizer contribution may allow an eligible person aged 55 or older to contribute the proceeds from selling a qualifying home. And the first home super saver scheme, which is a bit of a mouthful, is different again. It may allow an eligible first home buyer to withdraw certain voluntary super contributions and any associated earnings to help with a home deposit. Now, each of these options has its own eligibility rules, limits, tax treatments, and so on. The similar language can sometimes make them sound interchangeable, but they are very different arrangements. Let's start by having a closer look at salary sacrifice. This is an arrangement between an employee, you, and your employer, your boss, to direct part of the employee's pre-tax salary into super. Because the amount is not received as ordinary salary, it can reduce the person's taxable income, and the contribution is generally taxed inside super at 15%, rather than being taxed at the person's marginal tax rate. Now, this can make the option attractive for some middle and higher income earners, but of course, it doesn't suit everybody. It's important to note that your employer must still pay the compulsory super guarantee. A salary sacrificed amount is additional, and it must not be used to replace the employer's compulsory contribution. Now, here's a simple example. I'd like everybody to meet Mary. Now, Mary's annual income increases from $60,000 to $62,000 per year, and she wants to put that extra $2,000 into super. If she receives that extra money as ordinary salary, the example assumes that $640 is paid in income tax and the Medicare levy. That leaves Mary with $1,360 after tax, which she can contribute from her after-tax income. Now, this will generally count as a non-concessional contribution because the money has already been taxed. The example is deliberately simple. It doesn't include Mary's other income, deductions, offsets, or personal circumstances, but it does give an idea of how it works. But now let's see what happens if Mary's salary sacrifices that extra $2,000 instead. What that means is the full $2,000 goes to super before personal income tax is applied. Inside super, the contribution is taxed at the lower 15%, which is only $300. That means that Mary has $1,700 invested in her super. Compared with the after-tax contribution in the previous example, that means an additional $340 reaches her account. Now, that may not sound enormous in 1 year, but if those contributions continue and the investment returns compound over time, that difference can grow into thousands of dollars. Again, this is just an illustration of a principle rather than a recommendation for Mary or for anybody else. But let's extend Mary's example over 10 years. If she contributes that after a tax amount each year and the investment earns, say, 6% annually, the example produces total savings of over $17,000. If she salary sacrifices instead, that example produces up to over $22,000. That's a difference of approximately $4,400 over a 10-year period. $4,400 could go a very long way in retirement. Now, again, the calculation doesn't include employer super guarantee contributions, fees, changing investments returns, or tax variations. Real-world results will, of course, be different. But again, this example demonstrates how a larger amount invested earlier will benefit from compounding over time. Now, if that sounds exciting, before anybody rushes off to arrange salary sacrifice, there are a few things just to be wary of. Check whether your employer or a salary packaging provider charges administrative or consulting fees. Now, these costs can reduce the overall benefit that you would get. Keep an eye on the concessional contribution cap, remembering that it includes employer super guarantee contributions as well as salary sacrifice and other concessional contributions. It's also worth looking at your household's cash flow. Money contributed to super is normally preserved, which means it may not be available for ordinary expenses or emergencies. You still need to be able to pay for things in the meantime. And if the decision is significant or the calculations are complex, consider getting professional, financial, or tax advice. We'll move on now to downsizer contributions. Now, the rules here may allow an eligible person aged 55 or older to contribute up to $300,000 from the proceeds of selling a qualifying home. For a couple, each eligible partner may be able to contribute up to $300,000 themselves, so potentially allowing a combined contribution of $600,000. A downsizer contribution does not count towards the usual non-concessional contribution cap. It does, however, become part of the person's super, and so, of course, affects their total super balance, which means that transfer balance arrangements and future Social Security assessments can be impacted. Despite the name, there's no actual requirement to buy a smaller property. In fact, there's no requirement to buy another home at all. There are several important eligibility conditions. The property must be in Australia and generally needs to qualify at least partly for the main residence capital gains tax exemption. It must usually have been owned by the person or their spouse for at least 10 years, and the contribution generally needs to be made within 90 days of settlement. A person doesn't necessarily need to have lived in the home for the entire 10-year period, and both members of a couple don't need to appear on the title. However, it is important to note that houseboats, caravans, mobile homes, and some retirement village arrangements will not qualify. This is definitely an area where the finer details will matter. Now, if you're considering a downsizer contribution, start by checking the eligibility rules very carefully. Contact your fund to make sure it will accept the contribution. You'll then need to complete the approved downsizer contribution form and give it to the fund either before or when the money is contributed. The individual is responsible for assessing their eligibility, but the ATO may later check the contribution themselves. If it doesn't meet the downsizer rules, the fund may assess whether it can be accepted as another type of personal contribution. And if it can't be accepted, it may need to be returned. So again, that's why getting paperwork and timing is so important. Let's meet Mary's friends, John and Diane. Now, they're both 70 and they sell their home for $600,000. John is the only person named on the title, but both John and Diane meet the remaining downsizer conditions. So even though Diane isn't on the title, each of them may contribute up to $300,000 to their own super account. Together, that means the full $600,000 sale proceeds could potentially be contributed. The final decision would still need to consider their broader circumstances, their existing super, contribution options, tax position, retirement income needs, and how the money may be assessed for Social Security purposes. We'll move on now to the First Home Super Saver Scheme, which has quite the opposite purpose. It allows eligible first home buyers to save some of their deposit through the superannuation system. The scheme applies to eligible voluntary contributions rather than the compulsory employer contributions. Both concessional and non-concessional voluntary contributions may be included, along with an amount of associated earnings calculated by the ATO. A person can generally withdraw eligible voluntary contributions of up to $15,000 from any one financial year, subject to a total contribution limit of $50,000 across all years. Now, the aim of this scheme is to take advantage of the tax treatment available through super while saving for your first home. Of course, there are rules, though. To be eligible, you must generally be over 18 years old when requesting the release, although you may have been able to make some contributions before turning 18. You must not have used the scheme before and generally must have never owned any real property in Australia. You need to intend to live in the property as soon as practical and for at least 6 months during the first 12 months after it becomes practical to move in. For couples, eligibility is considered individually. So, for example, one member may still qualify even if the other has previously owned property. Some special financial hardship provisions can sometimes apply where a person has previously lost ownership of a property, but they would need to be considered on their own merit. Now, the money can't simply be withdrawn directly from the fund. The person first needs to request a first home super saver determination form from the ATO. This confirms the amount available for release. It is important to request the release at the right point in the home buying process, ideally before signing a contract. Once a valid request has been made, it may take around 15 to 25 business days for the money to arrive, and the release can generally only be requested the once. Because the timing here is critical, anybody considering the scheme should become familiar with the process well before they're ready to sign a contract. After the funds are released, that person generally has 12 months to sign a contract to purchase or construct a home. The ATO does need to be notified within 28 days of the contract being signed. If a property is not purchased, the person may be able to recontribute the relevant amount to super, but again, the ATO needs to be notified and aware of that recontribution. The released amount includes deemed earnings calculated by the ATO, and part of the payment is included in a person's tax return, though some tax offsets can apply. There are quite a few deadlines here, so again, not to sound like a broken record, but careful planning does matter. Let's talk a little bit more about taxation, specifically the taxation of contributions. Non-concessional contributions are generally taxed when they enter super because, again, they have come from money that's already been taxed. Concessional contributions are generally taxed by the fund at 15%. That's lower than the starting marginal tax rate of 19%. Now, these can include compulsory employer contributions, salary sacrifice, and personal contributions, for which a tax deduction has been claimed. So we've covered these throughout the previous slides. For most people, 15% is lower than that marginal tax rate, which again starts at 19%, which is one reason super can be a tax-effective way to save for retirement. Now, different treatment can apply to high income earners, including additional tax under Division 293 rules, but that's something we need to speak to you about on an individual basis, or indeed speak to your fund or the ATO. There are also special rules for eligible small business owners disposing of qualifying business assets. The small business capital gains tax concessions may allow some sale proceeds to be contributed to super under a separate CGT cap. Examples of this may include small business retirement exemption and the 15-year exemption. These rules have detailed eligibility conditions involving the business, the asset, the length of ownership, and the person's age or circumstances. Amounts contributed under the CGT cap may not count towards the usual non-concessional contribution cap, but other limits can apply. This is very specialised territory, so anybody selling a business or a major business asset should consider professional tax and financial advice before acting. Now, we've talked about tax offsets quite a little bit, so let's take a closer look at some of them. The low income super tax offset, more commonly known as LISTO, helps eligible low income earners by refunding some of the contributions tax paid by their super fund. Eligibility generally requires adjusted taxable income of no more than $37,000, with at least 10% of income coming from employment or self-employment. The offset is calculated after tax information is available, and it's paid directly into a person's super account, up to a maximum amount of $500. For eligible people, LISTO can effectively prevent the 15% contributions tax from leaving them worse off than if the same earnings had been taxed outside super. Here's an example of how LISTO can work in practice. This is Amara. Amara earns $27,500, and her employer contributes $3,300 to super under the super guarantee. The super fund deducts 15% contributions tax, which comes to $495. After Amara's tax information is assessed, it's determined that she meets the LISTO requirements. Because her contributions tax was below the $500 maximum, the full $495 is refunded into her super account. Now, she may not receive that money as cash because it goes back into super, but it does restore the amount that was deducted from her employer contributions. Super also receives concessional tax treatment on its investment earnings. In the accumulation phase, fund earnings are generally taxed at a maximum rate of 15%, although the effective rate can sometimes be lower. Those earnings aren't ordinarily added to your personal taxable income each year. The tax is dealt with inside the super environment, so you don't need to do it as part of a tax return. Capital gains on assets held by the fund for less than 12 months may be taxed at up to 15%. Where an asset has been held for more than 12 months, the effective capital gains tax may reduce down to 10%. This tax treatment is one reason super can be effective for long-term retirement savings. The tax treatment of super withdrawals, however, can depend on the person's age and the components of their benefit. For many people aged 60 or older, withdrawals from a tax super fund are tax-free. Between preservation age, which is determined by your year of birth, and the age of 59, the tax-free component remains tax-free. However, the taxable component may be tax-free up to the low rate cap shown here on screen as $260,000. Tax may potentially apply above that amount. If super is legally accessed under the preservation age, and we'll have a look at some of those options in a moment, the tax-free component remains tax-free, but tax may apply to the taxable component at a higher rate. Different rules can apply to untaxed funds and death benefits. So again, if you're not sure where you stand, check the treatment relevant to your specific fund and specific payment. Now, when choosing a super fund, there are several possible pathways. Many employees can choose their own complying fund, or in other cases, an award or employment arrangement may determine where the contributions will be paid. If a person does not make the choice themselves, their employer may need to contribute to their existing stapled fund. And if there isn't one, the employer may use a default super product. Some public sector and defined benefit members may have more limited choice. If you are eligible to choose, the decision doesn't have to be made based on advertising or brand recognition. It's worth looking closely at the fund's costs, investments, insurances, and services. When comparing funds, begin with the fundamentals. Fees and charges matter. They reduce your account balance over time. Even a modest difference can add up over many years. Look at the investment options and the long-term performance, but make sure you compare similar options over a similar period. A growth option shouldn't be directly compared with a conservative option if you don't recognize their different levels of risk. Also consider customer service, online access, insurance, and any employer benefits, such as additional matching contributions. The Your Super comparison tool and the Money Smart website can help with research. But a rating or a league table shouldn't be the only reason for choosing a fund. Do the research, have a good read, and make sure you get the information that's right for you. Now, changing jobs is a good time to check what's happening with your super. Over a working life, it is easy to collect multiple accounts, and that may mean duplicated fees, insurance premiums, and paperwork. Combining accounts can make super easier to manage, but first check what you might lose. Insurance is particularly important. If you have a health condition, work in a higher risk occupation, or are a little older, replacing existing cover can be difficult and expensive. It's also worth checking whether changing funds affects employer contributions or a defined benefit entitlement. And it's not always worth switching simply because one fund had the best return last year. Super is a long-term investment, and that means that its performance will change, go up and down, ebb and flow over time. Now, insurance is often included in your super account. The three most common types of insurance are life cover, total and permanent disability cover, also known as TPD, and income protection. Now, life cover may pay a benefit to eligible beneficiaries after the member dies. TPD may pay if the member becomes seriously disabled and is unlikely to work again. Income protection may replace part of lost wages for a specific period when illness or injury prevents the member from working. Insurance through super can sometimes be cheaper because it's purchased for a large group. However, the premiums are deducted from your super's balance, so insurance can also reduce the amount invested for retirement. The purpose of insurance is to provide financial support when something goes wrong, and there's no way of predicting how things will ever turn out. That might mean that replacing income while someone can't work. It might mean helping with debts and medical costs, or providing greater financial security for your family after death or permanent disability. Some people are underinsured and would have a substantial financial gap if something unexpected ever happened. Others may be paying for cover that they no longer need, or maybe paying multiple premiums through several super accounts. Neither of those situations is ideal. Insurance needs can change as debts reduce, children become independent, your savings grow, and retirement approaches. That makes insurance something to review periodically rather than just set once and forget. The right amount and type of insurance will depend entirely on your personal circumstances. Think about your mortgage and your other debts, the income that your household relies on, your family expenses, and how long support might be needed. Consider resources that are already available, including super, savings, investments, and family or partner's income. Default insurance through super is not tailored to each individual, so it could be more or less than you need, and exclusions or eligibility conditions can apply. Cover outside of super may have other different features, including broader income protection or trauma insurance. So before cancelling existing insurance or changing anything, make sure that replacement cover is active. Once old cover is gone, it may not be possible to restore it on the same terms. Now, super is treated differently under Social Security means tests depending on age and how the money is held. If you are under the age pension age, the super in accumulation phase is generally exempt from the income and assets tests. In other words, it doesn't reduce your payments. If the money has been used to start a superannuation income stream, then that income stream may be assessed. And once a person reaches age pension age, which is currently 67, their super is generally assessed whether it remains in accumulation or has moved into the pension phase. Its current value is considered under the assets test, and deemed income may be considered under the income test. The same principles can also affect a younger partner's assessment in some circumstances. Now, we've talked today about how access to super is restricted, and that there are very serious rules and administrative restrictions around it. And that is a fundamental part of the system. Super is intended for retirement, so it's only able to be released when a condition of that release is met. Be very cautious of promoters offering a way to unlock super early, particularly if they suggest establishing a self-managed fund and transferring the money out. Illegal early access can lead to additional tax, interest, and significant penalties. The withdrawn amount may be included in assessable income, even if your money is later returned. Fees paid to any promoters may also be lost. If you are facing financial difficulty, it's important to use legitimate hardship or compassionate ground processes rather than schemes promising a shortcut. Shortcuts are almost always the longest road. We talked a moment ago about preservation age, which again depends on your date of birth. For anybody born after June 1964, preservation age is 60. Earlier birth dates may have a lower preservation age, as is shown on the table now. Reaching preservation age doesn't necessarily mean unrestricted access. A person still needs to meet an appropriate condition of release. For somebody under 60, retirement generally involves ceasing gainful employment with no intention of returning to work for 10 or more hours a week. For somebody aged 60 or over, ceasing an employment arrangement can release benefits accumulated up to that time, even if the person later takes on another job. At age 65, access is generally available regardless of your employment status. A transition to retirement income stream may be available once a person reaches preservation age but continues working. It allows access to part of super as a regular income stream. People sometimes use it when starting to wind back those work hours and wanting to supplement the lower wages. Others may combine it with salary sacrifice as part of a broader retirement strategy. There are restrictions though. Generally, lump sums cannot be taken from this account, and annual payments are capped at 10% of the account balance. The strategy can affect tax, cash flow, super, and social security. It has become less advantageous in some circumstances as rules have changed. So again, current information and personal advice may be very valuable. And there are very limited circumstances in which super may be accessed early. Severe financial hardship may allow an eligible person to access up to $10,000 in a 12-month period. That person must meet conditions involving their financial position and receipt of an eligible income support payment. Compassionate grounds can apply to specific expenses, including qualifying medical treatment, medical transport, disability modifications, palliative care, funeral costs, or preventing foreclosure on a principal home. Terminal medical conditions may also allow release where the medical certification requirements are met. Death is another condition of release. Because super doesn't automatically form part of an estate, it's important to review death benefit nominations and seek estate planning advice where appropriate. I cannot stress importantly enough how much you need to talk to your super fund about having that set up. Let's try and bring all the various main parts that we've talked about together. Money can enter your super account through personal contributions, employer contributions, government co-contributions, listo, and investment earnings. Money can leave your super account through contributions tax, tax on investment earnings, fund administration and investment fees, and insurance premiums. Your final balance will reflect everything that has flown in, everything flowing out, and the investment performance achieved along the way. What this means is that growing super is not just about contributing more. It involves reviewing fees, removing unnecessary duplicated accounts, choosing appropriate investments, and checking whether insurance still meets your needs. Small improvements in several areas can make a very meaningful difference over a very long period. We've talked about how important it is to check on things, and we've talked about MyGov and self-service options, so we'll take a closer look now. Our self-service options here include MyGov, Express Plus mobile apps, and phone self-service options. They allow many people to manage routine tasks in a secure and convenient way outside normal business hours if needed. Of course, online service isn't the only option, and it doesn't suit everybody, but the purpose here is that it provides choice. For super specifically, linking the ATO to MyGov can be especially useful because it may allow you to see your super accounts, find lost or ATO held super, and consider consolidation options. Here's something to think about. Most of us already use self-service tools in everyday life, whether that's online banking, shopping, booking travel, checking in for a flight, going to the drive-through. Government services are moving in this same direction. Our tools are being designed to make straightforward tasks quicker and available around the clock. Through MyGov and linked online accounts, people can complete many routine transactions without needing to call or visit a service centre. If digital services aren't comfortable for you yet, that's totally fine. There are guides and support services available to help build your confidence gradually. MyGov provides one account through which you can link a range of Australian government services. This can include Centrelink, Medicare, child support, the Australian Taxation Office, along with several other services. For managing super, again, the ATO is particularly useful. A MyGov digital assistant is also available all around the clock. You'll find it by selecting the option to ask a question on a MyGov web page. If you do need further help creating an account or linking a service, assistance is available through the MyGov Help and Information Phone service. Now, sometimes it can be easier to have somebody you trust help with your dealings with Services Australia. For that reason, you can authorise a person or an organisation to ask questions, make updates, or act on your behalf, depending on the arrangement that you choose. This might involve appointing a nominee, a person permitted to inquire, or a person permitted to update. Having a representative does not stop you from speaking with us or managing your own affairs. It's simply another avenue of support. Different government services do have different authorization rules. So a person authorized for Centrelink matters is not automatically authorized for Medicare, child support, or the ATO. So it's always best to speak to them about your options individually. And again, if you would like to use some of these online services but need a little guidance, there are step-by-step help guides and video demonstrations available. These cover common tasks such as creating a MyGov account, linking services, updating contact details, reporting employment income, and managing information online. The Be Connected website is another helpful resource for people who want to improve their digital skills and confidence. You don't need to learn everything all at once. Start with a simple task, such as checking your details or viewing a letter online, and that can make the next task feel much easier. I think it's safe to say we've covered a lot of ground today. But again, you don't need to remember every rule or every figure. And that is where the Financial Information Service comes in. We can help you understand financial concepts, including super, tax, investment, social security, and retirement planning. We can help you explore how general rules may interact with your circumstances and explain the possible advantages and disadvantages of different options. Again, we are an information service only rather than a personal advice service. The final choice is always yours. If you are unsure what questions to ask your fund, accountant, or financial advisor, or you just don't know where to start, a conversation with FIS may be a useful starting point to get some information. If you would like to speak with a Financial Information Service officer, call 132 300 or the number you normally use to contact Centrelink. When the automated service asks why you're calling, simply say Financial Information Service. Contacting by phone is generally the best point of access. Depending on your needs and the services available, we can generally resolve your inquiry over the phone. But further support may include video chats, face-to-face appointments, community outreach, webinars such as this one, or presentations out and about in the community. If your situation is more complex, sensitive, or maybe a little more involved, an appointment may give us the time to work through the information a little more closely. We would be able to have a look at booking an appointment for you when we have you on the phone. MoneySmart is another valuable place to continue your research. It's an Australian government run by the Australian Securities and Investments Commission, or ASIC, and it provides free information, calculators, and practical tools. Its superannuation resources in particular can help with comparing funds, understanding fees, reviewing insurance, and estimating how contributions may affect retirement savings. MoneySmart does not remove the need to consider your circumstances, but what it can do is make financial concepts just a little bit easier to understand. And if you're somebody that likes me, like me, likes to test different scenarios, its calculators can be especially useful. Just remember that calculator results are estimates based on the assumptions entered. They're not necessarily a prediction or a guarantee. Services Australia also has specialist services for people who may need additional supports. These include the Centrelink Indigenous Call Centre, the Multilingual Phone Service, grandparent, foster, kinship and care advisors, aged care specialists, social workers, and the Farmer Assistance Hotline. If you are somebody that is hard of hearing or has a speech disability, you can also contact us through available TTY or National Relay Service options. The phone numbers are displayed here on the screen, so you may wish to know any that are relevant to you. You can always watch this webinar back, or you can find this information on our website. And that brings us to the end. Thank you very much for joining us today. I hope that the session has made superannuation feel a little clearer and perhaps prompted you to take a closer look at your own account. The most useful first step a person can take is usually something simple. Check your balance, review your contributions, look at the fees and insurance, make sure your contact details and your beneficiary nomination are up to date. Remember that super is your money for your future. It's a gift to yourself. Paying attention to it now can give you more information, more choices, and more security later in life. A big thank you to everybody from everybody here involved in today's webinar. Take care, and we hope to see you at another session soon. Thank you, everybody.